House Speaker McCarthy says that we're not raising taxes because we're spending too much. In fact, this is the 50-year high where the government is earning more revenue than ever.
I've been very clear with the president from day one. We're not going to raise taxes. We've got more revenue coming in to government in a 50-year average than any other time in the history. Only 2 other times do we have this higher percentage. But the problem is we're spending more than almost any time in modern history.
However, what he also stated that wasn't in the clip is that we are nowhere near a debt ceiling deal yet. That is right, the US potentially may default for the first time on their debt ever, up to the point to now where the Treasury Department has asked federal agencies whether they can make the upcoming payments at a later date. Imagine having to pay your insurance payment at a specific date and you don't have any money in your bank account. If you call and ask your insurance to pay it at a later date, it's probably not going to happen. Or you get hit with an overdraft fee. Now, there are 2 types of defaults that can happen, so don't mix it up. An actual default. This is the traditional meaning of the term, and it occurs when a borrower fails to make a required principal or interest payment to a lender. In the case of the United States, the default would occur if the government is unable or unwilling to make payments on its debt, aka treasury bonds. Default in these cases can either be partial, failing to pay back some debt, or full, failing to pay back all of the debt. However, this isn't the only kind of default that can occur. Now, there is another form. It is a technical default. Unlike an actual or traditional default, when a government fails to make payments on its bonds, a technical default occurs if the government fails to pay for its other obligations, even if its bond payments were made on time. So in the case of an actual default, if they can avoid that, that's perfectly fine. However, they might get hit with a technical default following that, so don't think they're out of the woods just yet. This would occur if they failed to pay other obligations, even if bond payments were made on time. For example, the US Treasury could decide to prioritize Treasury bondholders and pay them in full before paying out whatever was left to Social Security recipients, government employees, so on and so forth. While this would avoid a default in the traditional sense of the term, it could still negatively impact millions of Americans who rely on income from the US government to pay their bills. Now, what is going to happen if the US defaults? In today's video, I want to talk about what is happening, what United States' largest bank is telling their clients 3 things to do in case this does happen, and I want to share it with you so that you guys can prepare yourself and potentially what is going to happen with the overall stock market in general, as well as potentially your job. A lot of times, if the United States does default, we could lose millions of jobs in the sense that the government can't pay employees. So if you run a government job and you rely on the government to pay your bills, then this might actually be a bad thing for you. Now, the Treasury market visualized is a lot more complicated than we're going to jump into in this video, but I'll leave this here. Now that that's out of the way, this is the S&P 500 on the weekly time frame. And this is a guy, Nicholas, on Twitter. He goes, "Last time I post this, protect your families." And I thought this was pretty interesting, and that's why I'm bringing it up in the video. He assumes what's happening with the debt ceiling, what's happening with the economy, banks failing, so on and so forth. This is what is going to play out with the S&P 500. It's going to break relative highs, come up, retest a strong resistance level, get smacked back down to new relative lows, before essentially scaling back up, breaking new highs on the S&P 500 all-time highs, and scaling back down late 2025. Now keep that in mind. I find this interesting because there is something called the Benner cycle, which essentially predicts hundreds of years of market movement, or at least can, and has a decent track record. There are panic years, good times, and hard times, other known as A, B, and C, which you can see on the left-hand side of the screen. A, which is on the top, B middle, C bottom. A are years in which panics have occurred and will occur again. For example, 1927 through 2053. For example, 1927, 45, 65, 81, 99, 2019, 2035, and potentially 2053. B is years of good times, high prices, and time to sell stocks in values of all kinds. Essentially 1926, 35, 45, 53, 62, 72, 80, 89, 99, 2007, which, whoa, that was a good call out. 2016, 2026, 2034, 2043, 2053. And finally, you have C, years of hard times, low prices, and a good time to buy stocks, corner lots, goods, etc., and hold till the boom reaches the years of good times, then unload. Examples: 1924, 31, 42, 51, 58, 69, 78, 85, 96, 05, 2012, and 2023. So apparently, according to the Benner cycle, we are in years of potential hard times, low prices, and a good time to buy stocks, corner lots, goods, etc. With that being said, does this contradict the debt ceiling, and will the US default for the first time? Now, the percentage is very low. The percentage the US is going to default is merely 4% out of 100. So it's a very, very low chance that the US will default on their debt. They will lose a lot of power, and it will weaken the economy drastically. Now, here's what I want you to know. If you pay attention to the Benner cycle, which we have laid out in front of you, you will see that year 2023 has been essentially a good time to buy in. And with that being said, it has been. The reason for that is because the S&P 500 returns an average of between 8 and 12% year over year, and this year it is up already over 8%, and we are only in late May so far. Now, I'm going to give you the tips that the world's largest bank, JP Morgan, has been secretly telling its clients to do. There are 3 things to protect themselves in the case of a US default, because we cannot figure out which way the stock market is actually going to go. During the 2011 debt ceiling crisis, the S&P 500 dropped over 17% in a few days. JP Morgan says 2023 might be worse if that happens. JP Morgan to continue to be cautiously optimistic that discussions between President Biden's Speaker McCarthy will yield at least a partial deal to raise/suspend the debt ceiling. However, there is a growing risk as we approach the X date with a non-zero probability of a technical default. This is exactly why it was important to bring up the difference between a traditional or a technical default in the beginning of this video, in case you guys didn't know the difference between the two. JP Morgan is saying most likely McCarthy and Biden will come to an agreement. However, they have not yet, and McCarthy says they're nowhere near a deal, but JP Morgan says there's a growing risk that we actually might hit a technical default at least. So these are the 3 things JP Morgan suggests to do as a hedge in case that happens. Number 1, they recommend buying $25 to $35 June expiration call spreads on the VIX, 68 cents currently per contract. Buying one $25 VIX call June expiration and selling one $35 VIX call June expiration. What is a call spread? The long call spread gives you the right to buy stock at a strike price and obligates you to sell the stock at a strike price B if assigned. This strategy is alternative to buying a long call. Selling a cheaper call with higher strike B helps to offset the cost of the call you buy at strike A. That ultimately limits your risk. The bad news is, to get the reduction in risk, you're going to have to sacrifice some potential profit. So JP Morgan, the first strategy they're recommending is, this is a risk in which you will lose substantially less money or gain substantially less profit, but it will be an attempt to keep you stagnant. Now, this is the first hedge that they are telling their clients secretly to do in case of a US default. If you don't know what the VIX is, this is the volatility index. It measures the volatility on the overall market and how it is being traded. So during uncertain times, the VIX usually tends to rise. For example, if the United States defaulted on their debt tomorrow, chances are the VIX would go crazy, as a lot of people would be scrounging to buy and sell their equities in the stock market. Now, JP Morgan starts with the VIX is disconnected from macro data and rates, as it has been suppressed by low realized volatility resulting from option hedging, systematic strategy, releveraging, and intraday buy the dip speculative flows. They also added a mishap with the debt ceiling could put an abrupt end to this and cause the VIX to surge massively. During the 2011 debt ceiling crisis, VIX spiked to a peak of 48 from around 20. 2023 VIX compared to 2011 right here in this chart. The VIX curve currently isn't pricing in any material risk of a US default around the X date. Meanwhile, VIX skew is steep due to strong demand for out-of-the-money calls, and VIX fixed strike price volatilities are relatively low compared to history, making call spreads attractive per JP Morgan. In other words, these should be priced higher, therefore now might be a good time to grab these. Profit and loss for the VIX call hedge in percentages is right here. And number 2, the second hedge JP Morgan calls out. The second thing JP Morgan recommends is buying puts on the Russell 2000, which is the small cap sector. Buy 1 month 95% puts on the Russell 2000 or 0.85% of notional. During the 2011 crisis, the Russell 2000 was down 24% in a week, and the S&P 500 was down 17%. You can see right here in this chart. Adding the Russell 2000 has a higher exposure to high beta / cyclical names, and we, JP Morgan, believe the rotation out of cyclicals and into defensives low beta names is only 40% underway. Also, Russell 2000 has 7% allocation to regional banks. S&P 500 only has 0.3%. That could contribute to its underperformance should regional bank troubles resurface. If the US were to default and rates surged, high funding costs and credit crunch hit regional banks particularly hard. 1,095% Russell 2000 volatility is trading in just the 5th percentile over the last year, and the term structure does not show meaningful kink or risk premium around the X date. Example, the 1 million, 3 million at the money volume spread is in its lowest decline over the last year, said JP Morgan to finish this. And the third hedge, finally, and the most important thing, JP Morgan is telling its clients to follow Gergavin to stay up to date with the markets. And yes, I left that in there so that he did get a shout out since I did use his tweet from Twitter. Overall, guys, this is what's happening with the debt ceiling. You guys let me know your thoughts in the comments down below, how you're hedging. Do you agree with the United States largest bank on basically the two ways that you should be hedging in case this does happen? You guys let me know down below. Make sure to hit the like button on your way out. Hit the subscribe button. Also, join the Discord. The link is under the video. I'm in there on the daily. We have options trading alerts and we talk stocks all day long. Also, I'm leaving Moomoo linked under the video, which is a free broker. Once you sign up and make a deposit, it can literally be $1 into your account. You're getting up to 20 free stocks for doing absolutely nothing, plus free level 2 order book data, access to trading options, going long, going short, and more. And if you're from Australia and you use my link to sign up, you will get 10 free AMC stocks plus another 10 on top of that. The AMC ones are guaranteed. That is it, guys. That's what I got for you for tonight. I love you all. Lottery stocks out.